Oh, that's my...
Hello and welcome to Women of Influence podcast. Hi, I'm JaLynn with the J Group Real Estate Team.
The Great American Speak Off.
One of my favorites.
Hey, everyone. Welcome. Today, I have the privilege and honor of being with my lovely friend, Teresa Tims. Welcome, Teresa.
Thank you. Thank you for having me.
Oh, thanks for coming. So, Teresa, you are a true boss babe. You own your own freaking mortgage brokerage company. Like, how long ago did that whole thing happen?
Well, I remember the exact day that I started mortgages. I walked into this company called Marina Mortgage, February 12th, 1998. And I just knew that I wanted to be a loan officer and that I was going to be successful. And I wanted to work for this company, Marina Mortgage. And at the time, two of the individuals that were running the branch in Rancho Cucamonga, Patrick Huber and Emilio Nunez, they thought it would be super cute to test me and have me just wait and sit out in the lobby, maybe for like 4 or 5 hours. I'm not even kidding you. And I found that out after the fact, but I kind of took it with a grain of salt and made friends with all the office girls that were in the front. And 25 years later, here I am.
Wow. And what made you decide when did you actually start your own mortgage brokerage company? Was that?
I started off with a direct lender, and then I went to the broker side in 2000. And then opened my own branch in 2001. And then after the 2008 crash, probably in 2009, 10, there were a lot of changes happening in mortgages. And I was working at a friend's, after 2008, we all just kind of scattered to figure out where we were going to land and what was going to be the best fit for us. And I went back to the mortgage broker world. It was just most suited to me, with the most amount of options to help the consumer with the low rates. And also I was able to get a larger piece of the pie as opposed to working with a direct lender. And when all of these changes were coming out, I was like, I had my real estate broker license already. And to be a mortgage broker, you have to, and start a company, you have to have a real estate broker license. So I thought, maybe it's just time I, find a little office and just open my very own brokerage, hence TDR Investment Corp, DBA, TDR Mortgage, and TDR Real Estate Group. So that was in 2010.
That is so cool. I love it. And I'm sure there were a lot of things that you went through as a loan officer that kind of, you're like, you know what, I can do this better. I can do my own thing, and I can make things can you give us some examples as to, how you're able to better help the consumer now versus when you were just a loan officer?
Well, the mortgage brokerage channel has always had very competitive rates. And when you take, is that me? I thought I silenced my whole phone.
Oh, you're fine. We all have little interruptions, don't we?
Yeah. When you take the middleman out of it, right? You've got a big company. They have a huge office to staff, maintain, clean. They have marketing stuff and everything that they have to do. So what happens is the cost of that big brick and mortar operation get passed down to the consumer and the loan officer. So being a small broker shop, I have small overhead and I'm able to, a client does one loan application and I shop for the person to find the best fit for them in the mortgage space. And there's a lot of companies that consumers don't even know about that, have special programs or have access to, unique products for clients that they don't even know exist. But I keep up, I maintain all of those relationships. I'm constantly doing webinars and knowledge segments that are, seemingly endless because there's so much product out there and available to consumers today. And when I had gone briefly after 2008 to a direct lender, I was just used to giving my clients the best raw pricing and knowing that, hey, maybe things were a little bit easier in that channel and they had really nice marketing materials and I worked in a really nice office. I wasn't giving my client the best. And so that's why I, went back to being a mortgage broker and opened my own company, because I think that the world is your oyster in the broker channel, that you can truly give your client the best of what's out there.
I love that. And what a lot of people don't know as well is when they go to banks like Bank of America, Wells Fargo, Chase, etc., they're very confined to the type of loan program. And, they all have very similar qualifications, versus you might be able to help somebody who maybe doesn't have that traditional 2 years of pay stub income history. Maybe you can work with somebody who's self-employed and work off their bank statements, for instance. I mean, there's so much more flexibility.
Yeah, like a recent example of that was I had a client that has variable income. What that means is they do not work 40 normal hours a week. Maybe they work 35 normal paid hours and then 10 hours of overtime. Well, that is considered variable income, and you have to average that income over 2 years. But I know a company that will allow me to provide 12 months pay stubs. Okay, it is a pain to go through 12 months pay stubs and, put all the income on a chart. But that was make it or break it for 2 files that I recently had, actually, that had variable income. And because I have a relationship with the wholesale rep, each company is a wholesale company and they have a liaison, a wholesale rep. And one of my favorite wholesale reps, Laura Johnson, I met her when I first started at Marina Mortgage. So I know her since like 1998, and she is just a fantastic wealth of knowledge and advocate for me, the loan officer, advocate, for me getting my clients through. And with a bank, you don't really have an advocate, like when you go to a hospital and you've got, this medical thing happening with a family member, and the family member goes there and they don't get results from the doctors and the nurses. But once you bring in, myself, I go in, I'm an advocate for, that family member that's in the hospital by asking questions and figuring things out. And that's what a mortgage broker is. It's someone that is highly, highly credentialed. It's not easy to be a mortgage broker. They put us through more hoops than like, if I were just a regular loan officer, all the compliance things that we have to do. But I am an advocate for my clients. So I feel like, no, I know that I can get things done that, a bank or credit union cannot do.
I love that so much. Yeah, you truly are an advocate. And like, I've known you personally for, I don't know, 6 years now, something like that going on.
Years.
But, yeah. And I just love your personality. You're just so outgoing and friendly. And I'm sure that every client that you work with absolutely adores you.
Well, thank you. I, back at you. I was drawn to you the first time that I met you. I thought, who is this cute, bouncy bundle of energy sitting next to me? And we just happened to be at the same table. And then we just became friends after that. So,
yeah, which I'm so happy about that. Let's talk about interest rates. There's a lot of confusion out there about, how interest rates are determined. Like, why do they change every day? Can you touch on that and, talk to me like I'm 2?
Well, what I can tell you with 100% certainty is the rates are going to go up or they're going to go down. Like I, we subscribe to myself and, peers. We subscribe and follow very highly educated people that all they do are study the markets, right? Like they make predictions on, where the rates are headed. And I cannot tell you how many times they have been flat out wrong, not just off, but wrong. So there's so many variables that surround the movement of interest rates. And that's a very, very good question, because recently we had a little upset going into the Fed's interest rate reduction. I knew that rates could very likely go up after the Fed reduction, because I've seen it happen many, many, many times. And interest rates move off of many variables, a lot of them things that you wouldn't think, that they move off of market sentiment. They move off of what economists are saying, people are saying in the government. Anytime any of the Feds speak, the market reacts to that. And prior to the Fed meeting, it was discussed that rates were going to go down 2 or 3 times before the end of the year. So the market reacted to that news and adjusts rates accordingly. So prior to the federal funds rate reduction, we saw the lowest rates that we had seen since January. Earlier this year in January, rates went low because in December, the Feds came out and said that they were going to start lowering rates. So rates move off of long-term mortgage rates, move off of many, many factors, not just what the Fed funds rate is. Like with short-term loans, auto loans, home equity lines, we had the prime rate at 8.5, and then it went down to 8 because those rates move off of that pure hard number, but mortgages do not. It's anticipated that the Feds are going to reduce the rate 0.25% in November. I think that they're going to do that still, even though some jobs numbers came out that were spectacular that the market reacted to. And that's what really brought our rates back up to where they were in April. So all of those gains that we got leading up to the Fed announcement of lowering the rates were essentially wiped away. But so many businesses count on access to money, and many companies are crippled right now because they can't reinvest in their infrastructure. They can't hire. So I think that moving into next year, we're going to see downward movement. It's just kind of a question of not if, it's just when.
Got it.
Did that explain it? I don't know. It's such a complicated thing to explain to people.
So basically what you're saying is don't try to figure it out. It's gonna go up, it's gonna go down. Like whatever happens, just deal with it, right?
Yeah. So many people try to time everything perfectly in real estate. And I mean, who doesn't want to time things perfectly? I know I do. In the stock market, when I'm picking things in the stock market, I want to time things perfectly so that I could make the most money. But money is made over the long term in both channels. Having a good long-term goal and plan. People that bought 2 years ago that have rates in the 5s were sitting pretty when rates were like in the 7s and 8s. They felt like they did a good job. They've seen their equity grow. Right. And when they have the opportunity, because their properties are worth more money and they can get out of the FHA and go into conventional and save $200 or $300 a month. And then next year, when the rates go down, they can save another $200 or $300 a month. And maybe they had a $4,200 payment, but in 3 or 4 years, they're not going to have a $4,200 payment. They're going to have a $3,200 or $3,300 payment. So it's hard to say. It's hard to make your decision based purely off the market or rates. You're purchasing a home to solve a problem because you want something that is not going to go up. You want a fixed payment that you're leveraging against rent increases, basically, right? When you rent somewhere, if you don't own a home, you rent. And what do rents do?
They go up
all the time. They do. Have you ever seen a time when rents went down?
No, never.
I have never. Yeah. No landlord in the history of landlords is saying, oh, I'm going to lower the rent. They just don't do that. And so the owning homes for myself personally has been the greatest sense of security and building of wealth that I have. And so I know how important and how much it means to me. And I love to be able to share that with clients. I have people that I helped, 10 years ago, and, they have 500,000 of equity and a 2% interest rate. And, they're getting a home equity loan to, I don't know, buy a property at the river. And it's just exciting stuff.
That is very exciting. Yeah, I'm a true believer in creating wealth through real estate as well. I wanted to talk about, the importance of, when you are speaking to a lender, and I'm going to highly recommend that people reach out to you, go to TDR Mortgage, and the importance of understanding that it's not just about the interest rate. Can you talk about the other variables that go into getting a mortgage? And, there's like things like points, et cetera, and buy downs. Like, please enlighten us on all of that stuff that's going on.
Well, these are all such great questions. And going into a down rate environment, when you're purchasing a home in 24, at the end of 24, we're looking at doing mortgages with very low cost. So it's a fine line because affordability is tough for many people, even dual income families. It's still tough because in Southern California, if you're not prepared to pay a $4,000 or $5,000 a month mortgage, then you're most likely not going to be buying a home. A $500,000, $600,000, $700,000 house, that's what the payments are, and even a little bit more for a $700,000 house.
Crazy.
Insurance is a big consideration right now too. So number one, go into it with the preservation of as much cash as possible. So recently I locked a loan and it had no cost at all, like at 6%. But if the client wanted to pay $7,000 or $8,000, they could have had, 5.75. But to pay that extra money, they didn't save enough to warrant that extra $7,000 or $8,000 expense. So save that money, put it in your pocket, use it to improve the house, or keep it in savings, because down the road you're going to be able to refinance into a 5.5 or a 5.25 with no cost. So right now there's a little bit of pain and suffering, if you will, that you're just going to have to budget for a higher payment now so that you could offset the cost in the future. Another extremely important consideration is fire insurance. Anytime you're purchasing a home, just look around, and if you see mountains or if you see brush, pretty much know that property is going to need extra insurance. A $500,000 or $600,000 house a few years ago, the policy would have been like $1,300. Now on that same property, the policy is probably $2,500 or $2,800.
Yeah.
If it's in a high risk fire area, that policy is probably going to be 4 or $5,000.
Mm.
So when you're getting pre-approved, working with a really good realtor and loan person where you've got, an extreme professional on the mortgage side guiding you, an extreme professional on the real estate side guiding you, you're going to land in the perfect spot or the perfect position. And that's not to say some of those homes with the higher insurance are not worthy of evaluating or purchasing. It's just knowing going into it, not 2 weeks down the road. And then your lender comes to you and says, oh yeah, by the way, this is in a high fire area and your payment's going to go up $350.
Surprise.
Well, you know what I mean? Yeah. Surprise. So those are the kind of things that, doing due diligence up front in your financing.
Yeah.
And yeah, it's so important.
Yeah. And also things like more on the real estate side, but special assessments, sometimes those pop up and you're like, oh, yikes, it's an extra $226 a month in special assessments that you're going to have to pay for the next 30 years or however long you own the house, right? Things like that. And then there's property taxes.
I can't tell you how many times, I've been, I don't always get to control the real estate side of it, unfortunately, because when I'm working with one of my agents, they know to check for that stuff. They when they say, oh yeah, we're getting under contract, but there's like 120 HOA and then there's special assessment. So just make sure, you get all that information from title. And I'm like, okay, cool. We'll do our extra due diligence in the beginning. But then to be surprised by that, 8 to 10 days later, when it goes through underwriting, and the same thing, you have to go back to the client and say, hey, your payment's $200 or $300 more. I mean, I like clarity going into a situation. I don't like things to pop up. So we get through all of the pain in the very beginning in terms of the property.
Speaking of things like popping up, this is more related to real estate again, but working with this buyer, she's Canadian, getting her into a home in Glendale, Peoria, Arizona. And she specifically said, I do not want an HOA. I'm like, okay, cool. So we sent her home specifically without HOAs. So we're in escrow on this property. And in the title prelim, it pulls up that there's CC&Rs attached. She's like, what do you mean there are CC&Rs attached? There's no HOA. I'm like, yeah, this is really weird. So sometimes what can happen is a builder, when they build out a community, and this was like 30 years ago, they put those initial CC&Rs in place, but an HOA is never formed. There's no governing body. And so I had to like really talk her through that. I'm like, well, nobody's going to come after you if you rent your house out or, do this or do that, because there's no governing body. There's nobody there to like blow the whistle, so to speak.
That's a unique situation.
Isn't
Was
that
it
weird?
a planned unit development?
Yes, it's called 83rd and Thunderbird is the development, but no HOA was ever formed. But those CC&Rs are still attached to the property, which I found fascinating.
Was she moving to Glendale permanently, or was it going to be a vacation residence?
So it's going to be a home for her son, who's going to the Christian university nearby, and then also for her mother to live in. So it's going to be eventually an investment property. She's going to rent it out, but for the time being, it's for her immediate family.
Serving a purpose.
Yes. So anyway, sorry, I digress. I get off track. Squirrel.
When you talked about like the important things for people to do to prepare when they're getting ready to purchase, another important consideration that I wanted to touch on real fast is credit. So sometimes, let's say I'm working with a client and they're not in a big giant hurry, but I run their credit and I look for opportunities to increase their score with simple things such as, paying down credit cards, increasing a limit, sometimes getting added on to a family member's credit card can yield tremendous increase in your score, sometimes over 100 points.
Wow.
So that by the time they get ready to pull the trigger, and a lot of times that happens like around like school time or People are just wanting to get approved to see how much they qualify for, and they're going to kind of not sure what area they want to go into. You can have tremendous results with your credit score by tweaking a few things. Now, if you're going to go out and buy a house in 3 weeks, I can still give people tips on what they can do, but there's really not enough time for those scores to increase the way that they do whenever we kind of just start working with someone.
Yeah, that's important. I think it's also important for people to know when they are starting the process. I think it's important to shop around, obviously, but go to somebody who's highly experienced, like you are, Teresa Tims with TDR Mortgage, and don't shop around and like have your credit pulled. Like, don't go through, decide at that point in time that you're going to purchase a car or finance furniture. You're already planning and thinking of furnishing. So don't apply for that additional credit and have those credit inquiries on your report, because that can really hurt you as well.
One thing that a lot of buyers rarely consider are the tax benefits too. I mean, there's some pretty tremendous tax benefits that you get because when you're just paying rent, that rent just goes to the landlord, right? You just write a check, it goes. When you pay a mortgage, you're paying the principal balance down, and you get a tax write-off in the form of an interest deduction. So let's say you get a $15,000 interest deduction, depending on where you land in terms of, being married or your income. There's certain deductions that you can take, and those change too. Sometimes they're updated on a yearly basis. Off the top of my head, I don't know what it is, but I do know that you get an interest deduction. So let's say if you make, I don't know, $50,000 and you're taxed on someone that makes $50,000. If you get a $15,000 deduction, now you're being taxed on $35,000. So you're in a different tax bracket. So when at tax time, when clients are doing their taxes, a lot of times these tax professionals are saying, hey, you need to buy a house because you need a deduction. So that's what that means whenever the tax people say you need a deduction, because a house is a deduction.
I love that so much. Like, so many benefits of becoming a homeowner. Now, let's say that somebody really, really wants to buy a house, but they truly just do not have the down payment needed. What are some creative ways that you might be able to guide that person into, hey, look, I can help you. Here's how you can get that down payment.
There are a couple of wonderful conforming loan products available with low rates on a zero down. The VA home loan. So it's a benefit to veterans and their surviving spouses. There's a program called the USDA program. When you purchase in areas they have a map and there's designated rural programs. There's a whole slew of Fannie Mae and Freddie Mac zero down programs. There are other down payment assistance programs that come with higher interest rates. Some are grants where they give you the money. Most are ones where you have to pay back. All of those programs usually have certain income restrictions. And so the only way that you will know if you qualify is by going through the whole, loan application process, having someone run your credit, get all the documents together. And it also has to be somebody that, is aware of all of those programs. I can tell you, usually on those buyer programs, let's say if a rate today is 6%, right? That's a regular, you're doing 5% down, or you're doing FHA and the rate is 6%. If you do a buyer program, it's a down payment assistance, a buyer program where they give you down payment assistance in the form of a second or a third. typically those programs are a much higher rate, like 7.25, possibly even 7.5.
Okay.
So it increases the payment significantly. And so sometimes people are like, "Hey, thanks for showing me the programs I have available to me, but I don't want to pay an extra $400 a month to the lender, take a higher interest rate, and have this money that I have to pay back. I think I will look into my 401k and
Mhm.
try to do a hardship withdrawal through my 401k." Or if people don't have access, some people don't have a family member they can get, money from. They don't have a 401k. So if your only option is to get a house through one of these down payment programs, I'm I'm all for that because I feel like there's so many benefits. I mean,
Mhm.
not at the level to where you go to the poorhouse and you can't afford to buy groceries, though. You know what I mean? So
Yeah.
some people, the payment is just, they qualify on paper, um,
Mhm.
because the way that we do ratios and mortgages, let's say, 45% of your income can go to a house payment, and 56% of your income can go to a house payment and bills and things like that are on your credit.
Mhm.
But before, you had half of your money left over for, utilities and gas and things like that. But things are so much more expensive now. So
Yeah.
just because you qualify doesn't mean that you can afford it. And so a lot of times, I'm have conversations with people and help, walk them through what they what is a good thing for them to do. Sometimes I'm having conversations where, I just don't think, me personally, if I was your, sister, I would tell you, I think you should chill, save a little bit more money, pay your bills down, and save money. And maybe even, like, let's say your rent is 2,500 and you want to get into a $4,000 payment. So act like it's a $4,000 payment. Pay $4,000, and that extra 15, just put it in a savings account and see how you do. See how you're able to manage your budget with that extra $1,500 payment. And a house is not, when you rent, who fixes things mostly? Like the
Right.
landlord does.
The
But
landlord,
with
yeah.
a house, there's always stuff that goes wrong that you have to pay for, like plumbing things or landscaping things. So it's a big obligation to bite off, and you want to make sure that you're ready. You want to make sure that you've explored all the different options that are available to you.
That's great advice. I love that. If you're renting and you're looking to buy a house, go ahead and put that extra money that you would normally be spending on your mortgage and, stash it away. I just
Yeah,
love that so
see
much.
what that try it on, see what it's like to be pay that big payment.
Yeah, absolutely. So, what are two of the most important things that potential borrowers need in order to qualify for, let's say, just
Yeah.
a
So
standard conventional type program?
So I always say, when I'm talking to, my realtor friends, or when we're pre-qualifying, realtors contact us and say, "Hey, I have this buyer. I want you to give them a call." And there's actually three things: cash, credit, and income. And you have to have at least two of the three. You either have to have cash and income. Maybe your credit's so-so, but we can work with that, right? We could figure out your credit. But if you have, um, if you don't have cash and you have income and credit, we could figure that out with like some kind of buyer program. So you have to have cash, credit, or income. Like, it's a whole mixture of those three things to buy a house. And it all comes down typically to income. What is your income? What is your purchasing power based off your income relative to the bills that you have?
Mhm.
And sometimes, like, a lot of times I talk to people where they're just kind of not sure if they could even swing it. And so then what I tell them, I have a couple people right now that are in my pipeline that are working on getting me their documents, and they tell me what their credit is like. And so I have a good feel. I'm like, look, let's not even run your credit. Give me your income documents and let me put my eyes on them and give you an idea of what you would qualify for and what the payments associated with those are, so we can see if buying now is a good fit for you. Especially somebody that says, my maximum payment is going to be $2,700, but I want to buy in West Covina, which is a suburb outside Los Angeles where the average sales price is $750,000 or $800,000. Well, you're not going to get a $2,500 payment. But I never want to discount someone's desires or what they think they want to spend, because my job is to educate them and give them the information and start them down the path. Maybe the path, maybe they don't start in the next month or two, but they have an idea of where they need to be and what that path looks like.
Yeah. And speaking of income, I'm sure you have a heyday with self-employed borrowers like myself, who on paper, on my tax returns, it looks like I should be on food stamps, right?
Yeah. Self-employed people, gosh, so I have a HELOC, the rates on home equity lines are in like the 5s and 6s right now. And I have a HELOC at 11%, and I've been wanting to refinance it into a fixed rate, blah, blah, blah. But then I'm like, I'm self-employed. Like, I write everything off. And so I'm not going to qualify. So then you have to look at alternative things. As self-employed people, 20% down, right? So usually you can maneuver around the self-employed world if you're putting 20% down. That's where most of the non-QM loan product is, non-qualified mortgage. These are mortgages not backed by Fannie Mae or Freddie Mac, and they're designed specifically for self-employed people, such as the bank statement program that you mentioned. Some of the programs now, you can just do a simple profit and loss. You don't have to produce any documentation. The rates have been extremely competitive. I did a debt service coverage loan. I priced that out where that's basically an investment property. It was 2 or 3 units. I think it was 2 units off the top of my head. And it was pricing out at 6.75. And that's what the loan would price out on a regular full income qualifying Fannie Mae or Freddie Mac loan. So
wow, that's crazy.
The non-QM mortgages have really come into their own. They're high performing loans, which means the investors have high confidence to lend this money to self-employed people because they have a very low default rate.
Yeah.
So they're originated with largely pretty decent credit. Equity, minimum down payments are like 20%, high FICOs. So a lot of these investors and self-employed people, these notes are performing. And why wouldn't notes perform? How long have prices been going up? Since 2009? How many years is that? Right. We're like in the biggest upward, I thought the market was supposed to tank around 19 or 20, with real estate cycles, like the 10-year cycle. But here we are, 15 years later, still at this trajectory.
Still going strong. Yeah. I wanted to go back what you were saying about interest rates and the self-employed programs, the DSDR and things like that. And I was just thinking, even if you do have to pay a little bit higher interest rate for having to go through a self-employed program, it's a trade-off, right? Because you're not paying that extra money in taxes that you normally would have to. So it's like, you can't have your cake and eat it too, right?
Yeah, because some self-employed people, so there's this thing, if you've been self-employed for 5 years, and, we check that because we can see, with the Secretary of State in California, we can log in and see how long their corporation has been, alive or whatever. So if you're at an 80 LTV, loan to value, so that you have 20% equity in your house, self-employed for 5 years, you can get away with just showing 1 year of tax returns. Whoa. So I will go to my clients and say, okay, amend 2023, pay some taxes, So if you show $110,000, then you can have this conforming loan with the lowest rate, the lowest fees, it's a beautiful loan, but you have to go back, amend your taxes, and we'll just use that one years of taxes.
Wow.
You know how many times people have taken me up on that? Like
How
maybe
many?
one time in all of these years. So yeah, self-employed people are the cheapest. Like they do not, they're like taxes, no.
Oh,
Yeah,
yeah.
they do not
I,
like.
I actually, I don't know if I told you or not, my husband and I purchased a property in Spain last December.
Oh, I didn't
And
know that.
yeah, and so they do things a little bit differently over there, of course, but I had to go back and just amend one of my tax returns on paper. So it looked like I actually made more money. So I am actually one of those people that will follow my loan officer's advice to do that.
When I refinanced all of my properties I knew that like rates were going down. So in anticipation of refinancing, I showed a lot of income. I don't remember if it was 2020 and 2021, so that I could refinance. So that's a strategy that, when I'm having conversations with my, very financially savvy clients, where when you're going to be getting ready to refinance, you can do that. You can say, okay, I'm going to W-2 myself $150,000. I'm going to pay the IRS. I'm going to pay into my Social Security account. I'm going to fund all of these things. And it's actually kind of fun because when you do file taxes and you pay yourself on a W-2 as an employee, like I got money back. I got a lot of money back because I have a lot of really good write-offs with properties or whatever. But, as an employer, so me paying myself, I have to pay all kinds of employment tax just to pay myself. And then
Yep.
as the employee, when I get that W-2, I'm being taxed up the wazoo. So it can be very expensive to, pay yourself and to file taxes. But for some people, I think it's a good thing to do.
Yeah, absolutely. Well, my dear, we're going to wrap this interview up. You've been an absolute joy and pleasure. You've had so much great information.
Thank
I'm
you.
sure. Yeah, you're welcome.
I want to go to Spain. Like, where's your place? Like,
Yeah, it's in Malaga. It's on the, I guess, southeast. Do you know where Gibraltar is?
yeah.
It's like right towards the tip of Gibraltar. So you can like literally take a ferry and like go to Morocco even. It's like really cool. You have to look it up.
So
Malaga.
I don't know why I find that very hot and sexy for you to have a place. Do you rent it out when you're not there?
Yes, it's totally rented out on Airbnb. We have a property manager over there. Can't remember his name now. Oh my God, I'm having a brain fart. But yeah, they take care of all the bookings, all the, cleaning, all of the repairs, any maintenance, things like that. And oh, hey, I wasn't even looking.
Little story on Instagram.
So yeah, they charge 30%, but it's like well worth it. And we're still making money. We're still at a positive every month, even with paying all the expenses. Yeah,
Might you retire there, or is that like an ultimate plan, or it's just got a good deal on it?
Yeah, that's the ultimate plan. And I just wanted to share that we got a 2.9% interest rate.
Wow.
Well, I should say I did. Kelly couldn't get a mortgage because he's too old.
Oh, so they age discriminate in Spain.
Yes. And for me, the maximum term I could get because of my age, because I'm 55, was 15 years, which was fine because my mortgage payment's only like $1,300. So
what was the sales price?
The sales price was $380.
Wow.
And I had to put 50% down, 2.9% interest rate, because I'm not a resident. You're being a non-national, you have to put extra money down, which I was fine with.
I'll have to go to Spain because I was thinking maybe to retire in Cabo. I don't know. Well, I'm never going to like all the way retire, but you can work. As the years go by, less and less people actually come to my physical office. And so, having the expense of a physical office isn't it doesn't pay for itself like it used to. So I'm toying with the idea. I was maybe going to go to Florida, but I went down there and loved it. Like I fell in love with the Siesta Key, Sarasota area, but I haven't explored all of Florida. But gosh, with this hurricanes and the insurance crisis there, it doesn't seem that Florida will be very feasible to go to.
Yeah, it seems like it'll be super expensive. I guess I should probably hit end recording now.
Okay.
All right. Thank you, my dear. I will.
Thank you. I love you so much, and I miss
Love
you
you.
so much. Let me know. I know you hit me up one week. Things have been really challenging for me.
I'm sorry.